Ina mana, ina reo, ina iwi. Tēnā koutou katoa. No mai, haere mai, piki mai, ki tēnei zui. A very, very warm welcome to today's webinar. What role does private finance play in the race to net zero? My name is Laura Clark. I'm the British High Commissioner to New Zealand, and I'm your facilitator for today's webinar. And I'm really delighted to hear that we have around 360 people signed up today. So I'm looking forward to what's going to be a really interesting and engaging session. So ka nui te mihi ki a koutou. Thank you everyone for joining, and a particular thanks to our panelists. So we are meeting during the first week of COP26, shortly after the closing of the World Leaders Summit, which saw 120 world leaders gather in Glasgow. And now COP26 is widely seen as the world's last best chance to reach agreement on the action needed to avert catastrophic climate change and keep global warming to within 1.5 degrees. It's of course also critically important to support those who are already experiencing the effects of climate change. Now, I'm going to just say a few words of introduction. I'm going to, in a while, introduce a video from Aurum, who has been at COP26, and then we'll go into the rest of the proceedings. But I wanted, first of all, just to talk just briefly around the major outcomes that we've seen so far from the World Leaders Summit in Glasgow. We've had new commitments, new net zero commitments from countries such as India, Thailand, Vietnam, Brazil, and Nigeria, these fast growing economies. And those mean that now net zero commitments cover 90% of global GDP. Now that's really quite something when we think that when the UK became the COP presidency designate, I think it was only around 30 or 40% of the world's economy was covered by those net zero commitments. So that is a real good bit of progress in terms of ambition and the what we want to do. Of course, the how is more challenging. We had a few other really key declarations. The first is the Forest Declaration, where 119 leaders accounting for over 88% of the world's forests have committed to work together to halt and reverse forest loss and land degradation by 2030. And that's called the Glasgow Leaders Declaration on Forests and Land Use. And the endorsers account for over 70% of global emissions and around 80% of global GDP. And I think significantly for this meeting is it's backed by new forest finance commitments, including 12 donor countries committing to provide $12 billion of public climate finance from 2021 to 2025. That's really important. The second thing I'd highlight is the breakthrough agenda, which is countries committing to work together to make clean technologies the most affordable, accessible, and attractive option in each sector by 2030. And those sectors are power, road transport, steel, hydrogen, and agriculture, because of course it's all about how we transition our economies to make net zero possible. The other big thing that's been announced is the global methane pledge, with 105 countries pledging to cut methane emission levels by 30% by 2030. And we're delighted that New Zealand have signed all three of those pledges. So there's a lot there in terms of ambition. There's a big ambition in terms of how we're going to get to net zero by 2050. The challenge, of course, is exactly what we do to get there. And of course, finance is a critical tool of that. Finance, investment, and the private sector is, of course, how we're going to drive the investment in innovation, the investment in new technologies. And of course, as we all know, and as Nick Stern said years back, the longer we wait, the harder and more expensive it becomes, the more devastating the consequences of climate change. And so really what we're trying to do is mobilize action now. So finance is a big part of how we meet those ambitions that we've set out. And I want now, if I can, to turn to our video from Aurum, who has been in Glasgow, who will set the scene a little bit for Finance Day as is taking place in Glasgow today-ish, time zone allowing.
Kia ora tātou, and greetings from Glasgow, where it's my very great pleasure to be covering the COP26 climate negotiations. I feel this is the event I've been practicing for over 4.5 decades and counting as a business journalist. And thank you too very much for giving me the opportunity to say how vital I believe your meeting is today. It's excellent news that some 250 of you have gathered virtually to progress the very crucial driver that sustainable finance is absolutely vital to accelerating the interventions that are required desperately to reduce carbon. I make no apology for upping the pressure on you by adding the words "is absolutely vital." We all know how much we can achieve if we drastically reduce carbon and methane emissions over the next decade, and how dire the consequences are if we don't. If we don't, we stand little chance of reaching net zero by 2050, which we and all the people of the world have to do if we want to keep global warming to a more or less manageable 1.5 degrees centigrade. Your gathering today is just an early sign of the importance and value of Toitū Tahua, the Centre for Sustainable Finance, and its crucial role in implementing the Sustainable Finance Forum's 2030 roadmap for a sustainable financial system. The Forum and roadmap are very impressive outcomes from the Aotearoa Circle, and they give me great confidence that the Circle will make equally substantial progress across all its other work streams underway. I see the Circle as one of the absolutely key organisations in Aotearoa New Zealand's transformation to a deeply sustainable nation in all senses of that word sustainable: ecological and economic, social and cultural. After all, we have the greatest stock of natural capital per person of any country in the world, with the exception of major fossil fuel producers, and we know what trajectory they're on, the World Bank tells us. A fast rising tide of investors, from small to gigantic around the world, are undertaking the fundamental need and great opportunity for them to pivot their strategies to help humanity meet its vast sustainability challenges. Worldwide, sustainable investing assets, a rather broader function of the category than just ESG, increased by more than 50% to US dollars 35 trillion between 2016 and 2020, according to the Global Sustainable Investment Alliance's 2020 report. And since then, the rate of growth has accelerated dramatically. Such a profound shift in global capital is very evident here at COP26. While almost all governments struggle to move fast enough or boldly enough on climate because of their political challenges from vested interests or political inertia from a large portion of their citizens, and New Zealand is just one of many examples of that, it is increasingly private capital in its many sources and forms that is stepping up to the mark, particularly for the benefit of developing nations. For example, here at COP, on Wednesday, November the 3rd, a couple of days from now, from when I'm recording this, the theme of the day is Business and Finance Day, although of course those subjects are vigorously pursued every day. There are high hopes here for substantial progress at this COP on a number of issues, such as measures to harmonise green accounting standards via the International Financial Reporting Standards and other frameworks. Yes, it's a bit of an alphabet soup around those standards and they sound dull, but they really do matter. Another example are calls for the multilateral development banks to get more creative in how they create blended finance tools to back green emerging market projects. The goal here is to enable private sector money to be employed for green projects. A third example is our efforts to remove the risks around emerging market projects by, say, the pooling of foreign exchange exposures and the creation of a green kite mark to designate which projects are compliant with the Paris goals. These steps would also be very important in terms of helping private sector money to flow into the developing world. A fourth example is efforts to make the carbon offset market appear more credible, And that, of course, is hugely important for us in New Zealand as a potential source of those credits in international markets. But of course, our necessity under our government's current plans, which I must admit I'm not happy about, spending large sums of money on international credits, but should we need to, it's really important that those markets are credible. Now, all this is controversial since there are a fair few activists out there who think the entire offset market is very questionable indeed. However, it genuinely plays an important role if those credits are very credible. And of course, the corporate sector is very keen to develop that. And then a fifth example calls for consistent carbon pricing from one country to the next, or within countries, if they have rather mixed markets. This, of course, is a very fraught issue, often shelved, since the US government in particular has been resisting this, along with China and some other countries. But there are certainly do expect more calls for this from business. Now, while that's a very international perspective of all that's moving on finance, we know exactly how many of those issues will play out for us in New Zealand, and therefore the opportunities that you'll be working on, and very complex challenges that are not easy to solve, but I'm convinced with great creativity and a sheer determination to do so, that's going to be possible. So I've been learning a lot here, more than I can convey in my reporting for Newsroom each day. So I eagerly look forward to being home and out of quarantine on December the 2nd, so I can catch up on how your day's gone and your ambitions for the future, and relay more of my learnings here. So wishing you all the best in today and in the month or so ahead, and look forward to catching up with you soon. Mā te wā.
Well, kia ora, Rod, and thank you very much for that report, setting the scene for Finance Day and reporting back from COP26. It all feels a little bit like time travel, this, doesn't it? But not just with the time difference, of course, with pre-records. So I thought I would complement that. And it's really, really good to hear those reflections from Rod, and particularly, talking about this profound shift in global capital, and of course, private capital really stepping up to the mark. So I will just talk very briefly about what did happen at Finance Day in Glasgow yesterday. So Mark Carney announced that the GFANZ, the Glasgow Financial Alliance for Net Zero, now has $130 trillion of capital from 450 from more than 450 firms across 45 countries, all committed to net zero by 2050. And that represents 40% of the world's financial assets, and will, as our Chancellor Rishi Sunak said, help rewire the entire global financial system for net zero, because of course rewiring is what we need. We need that fundamental transformation. Another big development was that Mark Carney and our Chancellor Rishi Sunak convened 36 international partners, including New Zealand, in supporting the establishment of a new International Sustainability Standards Board, or ISSB, to develop comprehensive global baselines for sustainability reporting standards under robust governance and public oversight. And of course, New Zealand has long shown leadership in this area of climate finance. The UK, in my third update, has just announced its own financial disclosure plans to require most big UK firms and financial institutions by 2023 to disclose climate risk and show how they intend to meet climate targets in line with our net zero target. And the UK is working to become the first ever net zero aligned global financial centre, in the hope that really helps build the momentum for other financial centres to follow suit. Well, I hope that's a useful scene setting for today's event, which is designed very much to link into Finance Day at COP26. And I would now like, if I can, to introduce Bridget Coates, who is really going to introduce this session, talk more about the substance of what we're going to go through. But if I can briefly introduce Bridget. Bridget is the chair of Toitū Tahua, the Centre for Sustainable Finance. She took on this role after co-chairing the Sustainable Finance Forum implementation team. She is also chair of Fonterra's Sustainability Advisory Panel to the board, chair of Toitū, chair of the Real Estate Institute of New Zealand, and is a director and trustee of Mindful Money. Well, tēnā koe, Bridget, and over to you.
Kia ora kutu katoa, and thank you, Laura, for your support for our event. You are really one of our leaders of this movement in Aotearoa, New Zealand, and we are very grateful to you. Laura has offered support throughout our journey, and it's just terrific to have you on our team, so to speak. Today we are celebrating net zero pledges by some of our leading fund managers. And in addition, it's COP Finance Day. So it is really the perfect occasion to recognise and celebrate the critical role that the private finance system is playing and leading this transition. So a few words by way of context. Toitū Tahua, the Centre for Sustainable Finance, is engaged in nothing less than the transformation of our finance ecosystem in Aotearoa, New Zealand. We're focused in three main areas. The first is greening the financial system. The second is financing the transformation. And thirdly, changing mindsets across our country. It's a very worthy challenge for every one of us, and we would welcome your ideas and active engagement in our 6 work streams, which are published on our website, and we would encourage you to have a closer look at the roadmap if you would like to do that. As kaitiaki for our children and grandchildren, we are highly conscious of the urgency of our work, and we're very, very committed to this task. I think we were all quite sceptical of whether COP was going to deliver against the enormous ambition that has been set for the meeting. But overnight and in the days before, and Rod and Laura both reinforcing these messages, there have been some very significant changes of relevance to this investment audience. The new International Sustainability Standards Board framework will be very helpful, as will the sector-specific standards that are also going to be announced. And I believe that will really take put impetus behind a lot of investment opportunities that otherwise might be quite complex, or much more complex than they need to be. There's a renewed dedication to mandatory climate reporting through TCFD type frameworks around the world, as we know well here. So we are, it's really positive to see all of these developments, and which will hopefully put the wind behind global funds managers as they invest in a low carbon future. As we all know, a fundamental reassessment of risk is occurring rapidly around the world. Funds are flowing towards institutions and companies that are responding and adapting. Global consumers and global employees are voting with their dollars. They're rewarding investment managers who can invest using multi-generational and multi-stakeholder perspectives, and who then can explain and justify their investment decisions accordingly. Across the whole system, reputations are being made and broken. Valuations are changing to reflect these perspectives. Go no further than Tesla, which now represents the same market value as the next 4 car companies combined. And it's not just a PR reputational effect. I was so interested to hear Erwin Jackson from the IGCC talking today about the rising cost of capital for Australian companies as a result of climate change concerns and lack of disclosure. He also stated that the Australian Stock Exchange has twice as much carbon exposure per dollar invested than the average of other markets. These are profound real-life impacts for fund managers to consider. We continue to need world governments to step up on a range of core issues, such as developing carbon market rules, as Rod said, and continuing initiatives towards standardizing taxonomies and measurement systems. And that way we can improve transparency and align incentives, and that will greatly amplify the pace of change. But once those parameters are set, you as the private sector can pick up the pace from there. It's estimated that 70% of the $30 trillion which is required for this transition will have to come from the private sector. Today, we're taking the time to celebrate our leading fund managers who have stepped forward to pledge to a net zero target. I want to acknowledge and thank Barry Coates, the CEO of Mindful Money, who is the convener of our new Investor Coalition for Net Zero. Barry conducted the survey into our funds management industry that has just been published today and that you will hear more about. This survey shines a light on our best and most far-sighted fund managers and hopefully encourages the many others in our market to follow suit. Thank you again all for attending, for your work in addressing the challenges of sustainability and climate change, and for your support for Toitū Tahua, the Centre for Sustainable Finance. I'll now turn back to Laura. Thank you.
Kia ora, Bridget, and thank you very much for setting the scene like that for us. And I'd like now to introduce Tom Aurum, who is the Director of Strategic Programs at the Investor Group on Climate Change. Tom oversees programs, advocacy and strategy across IGCC and AIGCC and leads New Zealand's policy and membership relations, physical risk and resilience policy, and assists on Asia and Australian climate policy analysis. Tom is a policy and advocacy specialist with 15 years of experience working across journalism and non-government organisations. Tom, I'd like to hand over to you. Kia ora.
Thank you, Laura, and thanks everyone who's tuned in today. So anybody paying attention will note the marked global shift among investors and their approach to climate change. Mostly mainstream investors began addressing climate change concerns a decade or so ago, principally through specific responsible investment funds, often driven by ethical considerations and consumer demands. But in the intervening period, several developments have made clearer the implications of the systemic nature of climate risk across portfolios. The Paris Agreement created a massive market signal, and the science firmed on the regional implications of worsening warming. Investors started running scenario analysis and stress testing portfolios and quickly discovered that there were profoundly poorer implications for investment returns under scenarios over 2 degrees of warming. In response, the last 2 years have been punctuated by a flurry of commitments and frameworks for portfolio alignment with the common climate goals of humanity, namely reaching net zero emissions by 2050 on a pathway consistent with meeting the Paris Agreement temperature goals, and making sure our only planetary home doesn't descend into chaos. This moment is basically representing a mainstreaming of climate risks and opportunities across global capital markets, or at least this is the beginning of that. As if to emphasize this, on Monday, the Net Zero Asset Managers Initiative, which is part of the GFANZ work that Laura mentioned earlier, announced a further 92 organisations have joined, taking the total signatories to 220. These organisations are managing a combined 57 trillion USD, though it should be noted that not all these assets are yet being managed under net zero alignment. We've also seen new commitments from large asset managers to net zero, aligning their portfolios to net zero emissions by 2050. And notably, 4 Crown investors in New Zealand, including the New Zealand Super Fund, recently signed the Paris-aligned investment initiative's net zero asset owner commitment. Over the last week, those commitments was joined by a number of large New York pension funds and some others from Europe to take the total number of signatories to 50. And another 61 have signed on to the separate but equally valued Net Zero Asset Owner Alliance initiative as well. Among IGCC's own membership across Australia and New Zealand, which does admittedly skew more heavily towards Australia, and Barry will provide more information specifically about the New Zealand market shortly, we are seeing these global shifts starting to play out closer to home. Our latest membership survey found that over 40% of the members now have a portfolio-wide commitment to net zero by 2050, and another 20% are actively considering it. This is up from 27% who had this goal in place last year. And ultimately, 2 years ago, there were very few mainstream investors with portfolio-wide commitments to net zero globally. I'd be underselling it to say events are moving quickly. It is important to understand that these global initiatives for net zero are not set and forget goals for 29 years' time. For many who sign up, it will require a step change in practice, but one IGCC and many of our members would strongly argue is necessary to remain competitive, meet fiduciary duty, and mitigate the climate risks to delivering sustainable returns for beneficiaries. These initiatives come with sub-commitments to ensure investors are actively working towards the end goal. These include short-term targets, disclosure, engaging on mandate conditions, comprehensive stewardship plans, and limitations on the use of offsets, among other things. And groups like IGCC have been working with investors, and trust me, we all spend a lot of time on midnight calls discussing thrilling topics like the merits of weighted carbon intensity metrics, to build a range of open source guides and frameworks to help investors begin their alignment journey. So let me touch on a handful of these. First, a set of guidance and expectations and an expectations ladder has been produced to help investors establish what we call investor climate action plans, or ICAPs, from wherever they are on their journey. And I note overnight, the UK government effectively mandated these types of plans for financial organisations and listed companies in their country, which may be a signal to come for what might emerge in other jurisdictions beyond the disclosure regimes we're starting to see pop up, including in New Zealand. Then there is the Net Zero Investment Framework. This framework offers a comprehensive approach on which a broad range of investors can make commitments to achieving net zero emissions and define strategies, measure alignment across asset classes, and begin the work of transitioning portfolios. The framework also has the advantage of having been developed in partnership with dozens of institutional investors, with many of them now implementing and testing the framework, such as BlackRock and Australian Super. The aim is to ensure the framework is iterative and evolves over time on the back of investor practice and the development of new practice. The same recent survey of IGCC's members found over 45% are now using this framework in some capacity. There are also a range of target setting guides to help establish short-term goals, from the Net Zero Asset Owner Alliance Protocol for 2025, the Science Based Targets Initiative guidance for financial organisations, and the soon-to-be-released Paris-aligned Investment Initiative target setting guidance. Now, it would be disingenuous for me to say that these frameworks and tools have all the answers. Committing to net zero by 2050 with the scale of economic transformation and the technology advances needed requires some degree of a leap of faith from investors. Although in saying that, what we need to do this decade to keep on a Paris-aligned pathway is well within our technical and financial capabilities, such as winding down coal power generation in OECD countries by 2030. Ultimately, there will need to be more innovation and development, more metrics, more data, more practice, and a stronger will across all investors to help deliver our end of the net zero transition. And for equity and fixed income investors, this means a lot of active stewardship to ensure companies effectively transform their way of doing business within a mere few decades. And for some sectors, this relies on tech that doesn't yet fully exist. So there's a lot to do. Given this, we need to accept portfolio alignment with net zero is to some extent currently a best endeavours exercise with an emphasis on the best. But as I've said, there is much already to get started on, and this shouldn't be a barrier to making the commitment. At any rate, investors are already grappling with climate risks through disclosure, consumer demand changes, mandates, market forces, policy shifts, worsening physical disruption, regulator guidance, and so on. Like it or not, investors are still operating on planet Earth, and climate change is the dominant megatrend that will shape our world from this moment on. As a result, climate change will be the biggest investment theme of this century. The initiatives to make a net zero commitment are now in place. The frameworks and tools are available to start implementing it. And in global capital markets, it is increasingly a bare minimum expectation. There is no time like the present. Thank you.
Thank you, Tom, for a huge amount set out there. And I really liked, that articulation that this is absolutely the big trend of the century. And there is really no time to waste. And that while there are some things that are no-brainers, sort of moving away from coal, in others, it's very much a leap of faith. No one quite knows exactly what path we need to take. We don't exactly know all the technologies that are yet to come online. And so it's really useful to get that sense of the frameworks, of the investor climate action plans that need to be in place, the guidelines, because no one is doing this on their own. And I think useful also to acknowledge that this is very much an iterative process because no one has done this before. So thank you for that. I'm going to introduce Barry now. Barry Coates is the CEO and founder of Mindful Money and is on the board of the Sustainable Business Network. He started work on ethical investment around around the establishment of the UK Social Investment Forum in the early 1990s. He was Executive Director of Oxfam for 11 years, served as a Green Party MP, and has a Master's in Management from Yale University, majoring in finance. Now, for those of you who are wondering why we have both a Barry Coates and a Bridget Coates on our panel, the answer is that they are siblings. It's not some coincidence. So, Barry, thank you very much. Tēnā koe, and over to you.
Thank you, Laura. And you've divulged the little secret of siblings working in the same space. Kia ora, no mai haere mai ki tēnei hui mariko, ngā mihi nui ki a koutou. So welcome to this online seminar. I want to start with the why of net zero. And just as a little anecdote, I recall from many years ago, a CEO commenting in a seminar on corporate governance, said, "Sticks and stones may break my bones, but institutional investors can fire me." So investment capital has the power to hire and fire CEOs and to influence corporate strategy. But it also has the responsibility to use that power for the right purposes. Until recently, that governance power has been used primarily for the pursuit of short-term returns. Real-world consequences of investment decisions have generally not been considered, contributing to huge damage to societies, the environment, and of course, particularly to our climate. But as you all know, change has started. There's been a dramatic rise in bringing the real world into investment management, whether it be called ethical, responsible, or ESG investment. But now climate change creates an even stronger case for transforming finance. A starting point for most investment managers is the need to include the impact of climate change on financial risk and return. So fund managers are, of course, acutely aware of managing risk. And as we see in our world, climate risk is material. It may be physical risk from extreme weather, the risk of policy or law change, risk from disruption to markets, or the reputational risk for those that fail to change their business practices. And we already see ways that the risks of stranded assets have resulted in a huge decline in the value of coal companies and fossil fuel companies over the past decade, and others, high-emitting companies, will follow. But there's an upside to these changes. We are in the process of replacing the energy sources that are a foundation of our economy. The winds of change are not only creating turmoil and risk, but also new and exciting opportunities. Beyond a few outliers like Tesla that we've already talked about, early studies are already showing the high returns that can be earned from businesses delivering climate solutions. So there's returns to be made. As well as the impact of climate change on finance, which is what we've been talking about, funds are also now starting to come under pressure to reduce the impact of finance on the climate. So firstly, there's clearly public demand for investment to take climate change into account. So annual surveys by Man for Money and the Responsible Investment Australasia show that around 3/4 of retail investors want their funds to avoid fueling the climate crisis, and particularly have concern around fossil fuel companies. And this proportion is increasing. The public are also looking for their funds to contribute to renewable energy and other climate solutions. But there's another reason. Beyond climate demand, a growing number of funds are taking action on climate change, not because of the financial reasons or not because of consumer demand, because it's the right thing to do. In the hard-nosed world of finance, this is often easily dismissed as altruism, as if money managers have no responsibility to address the crisis that threatens us all. It's true that investment has a very powerful role in our economy, but it also has a crucial responsibility. Funds can and should have a purpose, as we've been reminded by Larry Fink from BlackRock. And that purpose should be beyond maximizing short-term returns. The purpose should reflect the aspiration of stakeholders, the role of the funds in society, and a future for the children of all the people who work in the funds and beyond. Fund managers need to recognize that a 1.5-degree world is a much better world for investors as well as everyone else. We need to hear more New Zealand funds articulating the vision and purpose of their business beyond risk and return. So these are some of the why factors, some of the factors that have driven the huge growth in global net zero pledges that Tom Arup has described. The announcement by Mark Carney from COP26 that US dollars 130 trillion has now been under management in net zero aligned assets under management from 450 organizations. This is a huge number. Investment strategies that are a result of those net zero emissions can have a real world impact. We'll hear more about this in the panel to follow. But as we've seen, there's also integrity measures built into the net zero processes, as Tom Arup described. So obviously, as well as celebrating the level of the pledges, $130 trillion, we also need to focus on the quality of the pledges. If some funds pledge and then set and forget their targets, we need to ensure there is public scrutiny and accountability. And the disclosure mechanisms around the target setting will enable that to happen. So we know that reducing emissions in portfolio has become good practice for fund managers internationally, along with the huge net zero pledges. But it's also increasingly a requirement. If New Zealand is to be part of a global system of capital, if we want to remain competitive, our fund managers will need to demonstrate that they're contributing to climate action. In giving the strong rationale for investment action on climate, it has therefore been surprising that there have been so few climate net zero pledges from New Zealand asset owners and fund managers. So Mindful Money came into this because our mission is to transform investment so that it becomes a force for good. We initiated a coalition for net zero because we see it as potentially a really powerful lever for change, and particularly in driving climate action. So in the coalition, I'm very pleased that we have Toitū, Tahua, the Centre for Sustainable Finance, recognising their leadership in driving an agenda for sustainable finance. And as you've heard, the Investor Group on Climate Change plays a crucial role as a leading organisation in Australasia for climate action by investors. The core members in the coalition are joined by other support group, which includes Sustainable Business Council, Sustainable Business Network, Toitū EnviroCare, and the Responsible Investment of Australasia. So we thank them very much for their support of the coalition. So the coalition's aim isn't to replicate international pledges. There are enough of those already, and our role instead is to encourage and support New Zealand asset owners and fund managers to get active in reducing their emissions, to develop plans and publish targets, and to travel the path towards committing to a net zero pledge. The coalition is primarily about the funds, not about the organisations that have initiated so far. So in order to find out more about the thinking of funds on net zero, we undertook a survey in New Zealand. It covered around 75% of New Zealand funds under management across fund managers and asset owners. And I'm deeply grateful to all of those who responded to the survey. And the survey report is being released today. It will appear very soon in your chat if it hasn't already. And the survey results showed a surprising thing. You know, when we started the survey, we really didn't know, apart from maybe the largest fund managers, how much interest there would be in making net zero pledges. A top line statistic from the survey is that 89% of the funds surveyed intend to make a net zero pledge. That's a stunning figure, and it shows that it's not only the largest funds that want to take this pledge to net zero, actually it's far wider across the fund management industry. We note, however, that most funds still have some distance to go before they're going to be ready to make such a commitment. And there's a high level of interest in capability building to help them along that path. The report that we're releasing celebrates those who have already made pledges. It provides profiles of BT Westpac, Mercer, Russell, and Pathfinder in the report, and QBE Insurance has also made a pledge. We also acknowledge the leading role that New Zealand Super Fund has played in setting climate targets and reporting progress. Subsequent to our survey, the Crown financial institutions also made net zero pledges. The New Zealand Super Fund, ACC, Government Superannuation Fund, and National Provident Fund, with funds under management of around $110 billion New Zealand. So the aim of the survey report is to provide information on net zero, support those who are on the journey towards deepening their climate action, and encourage them to make a net zero pledge. To the asset owners and fund managers in the audience today, we hope you'll deepen your emissions reductions, and we hope you'll consider adopting net zero targets. As a coalition, we look forward to celebrating those who make the commitment to long-term action. Ngā mihi nui kia koutou. So I'm now going to put on another hat, and it's my great pleasure to introduce our panel. I'm going to introduce them one by one, and then we're going to have a panel discussion. So let me first extend a very warm welcome to Matt Whineray. Matt is Matt is CEO of the New Zealand Super Fund. He first joined the Super Fund in May 2008, became Chief Investment Officer in 2014 and CEO in 2018. Matt was co-chair of the Sustainable Finance Forum, a program of the Aotearoa Circle, along with Karen Silk as the other co-chair. And the Sustainable Finance Forum, of course, gave rise to Toitū Tahua to implement the roadmap. The roadmap was launched in 2020. So Matt, a very warm welcome to you.
Tēnā koe, Barry.
Matt, can you kick us off by saying why did the Super Fund take this pledge, and what will it mean for your investment approach?
Sure. So we've had a climate change investment strategy for a number of years now, about 5 years. And when we kicked that off, we didn't have a defined endpoint for that, but a key part of it was reducing our exposure to emissions and to reserves, fossil fuel reserves. So what we were really doing was focusing on how do we move ourselves relative to the market or to the benchmark portfolio. This pledge that we've just committed to it's a big step, but it's a natural next step for that strategy. So when we started, as I said, we didn't have that endpoint in mind, but we thought, we knew enough to know what the direction was. We needed to get on with it, and things would evolve. Data would evolve. Our understanding of the risk would evolve. Our reporting would evolve. This move now, this commitment to the pledge, gives us a bunch of additional things to do. So we will transition to a target that is an absolute target rather than a relative one for the portfolio. We're doing it with the aim of reducing real economy emissions, which is a really important part. So it's not just decarbonising our portfolio through not owning some things, but stepping up the engagement with companies in order for them to decarbonise, to reduce their own emissions. We'll set some interim targets for 2030. We reduce the operational emissions for us, the guardians, as the management entity, obviously, and we'll produce that investor climate action plan that Tom was just talking about within the next 12 months, which shows how we get there. So we've already come a reasonable way in terms of our reductions or decarbonising. We're about 40% down in emissions intensity versus the benchmark, the market portfolio. We're pretty much entirely out of fossil fuels, so our listed portfolio owns no fossil fuel reserves. So we've already made a significant step along the way, but this will just say, let's align ourselves now. That's the Paris Aligned Investment Initiative. Let's align ourselves now with that longer term goal and make sure that we're on a trajectory which gets us there.
That's great, Matt. Given the fact that you are in that position of having already set targets, exceeded your targets, and then done a progress report on them, can you talk about your experience from that? Because others are going to be doing the same thing.
Sure. So when we started, we set some targets. As you say, we've managed to achieve those. We've reset them, stepped up the ambition. What have we learned? We've learned a number of things. We've learned that you can do quite a bit in terms of carbon reduction without a great deal of impact on the broader portfolio. There's concentration of emissions. There's concentration of reserves. So that makes it really doable. We've learned also our climate change strategy has been positive for our investment returns. Admittedly, this is only a few years, but it's certainly been positive. And so that's the strategy. In terms of the reporting, what have we learned? You won't get it right the first time. You'll see, you'll learn about it. You'll learn more about both your portfolio and your own operational emissions. Secondly, it's not really about reporting. Although all the focus is on reporting, actually it's not about reporting. It's about how you've incorporated this risk and into the decisions that you're making. So when you think about those TCFD categories, governance, strategy, risk management, metrics and targets, reporting's last. It's how have you incorporated it? How have you changed the way in which you've made decisions? Lastly, we've learned that the data quality continues to evolve. You know, just because you can't solve it all doesn't mean you shouldn't start. And we certainly started with some data that was a bit patchy in some places. And then finally, assurance, which is going to become really important. That's hard. That's evolving as well. The whole ecosystem is learning as we go how to get more comfort in the reporting that we're doing, for example, or the reporting that the companies are doing that we rely on. So the big message is we've learned a lot. We're going to continue to learn a lot. The whole place is evolving, but every year we get a little bit better at it. We understand it a bit more, and we can get a bit more ambitious with it.
Great. Thank you, Matt. Those are really, really interesting insights. And we'll come back to a few of those in our discussion. Let me bring in Karen. So Karen Silk is General Manager of Linc Strategy and Sustainability at Westpac New Zealand. She's leading the transformation of Westpac's outsourced services program, along with strategy and sustainability functions. Karen's also been CEO of Westpac's fund management business, BTNZ, since 2017. She's chair of New Zealand's Sustainable Business Council. And as mentioned, she was previously co-chair of the Sustainable Finance Forum. So very warm welcome to you, Karen.
Kia ora.
Karen, I'm going to ask you the same question. Why did BT Westpac undertake a pledge, and what will it mean for your investment approach?
Yeah, sure. Thanks, Barry. Really good questions. Look, as one of New Zealand's largest fund managers, we recognise the responsibility we carry to understand and support positive outcomes that encompass more than economic. They need to encompass broader environmental and social spheres. And it's not just because our investors, New Zealanders, are increasingly vocal about wanting to invest in funds that align with their own social and environmental principles. It's also because we know that if we take a more holistic approach to understanding and addressing issues that lead to future financial risks and opportunities, as you've already referred to before, ultimately you're going to build a more resilient business and you're going to build more resilient outcomes. And that's essential when you're managing other people's funds over a time horizon that extends into the decades when you think about KiwiSaver, and it's not just about the next quarter. So joining up to this initiative, the pledge, is a logical way for us to cement some of the earlier commitments that we made and embed it into the formal sustainable investment policy that we developed midway through 2020. That policy supports a commitment that we made in 2020 to reducing our emissions in line with a 1.5 degree pathway. And so when I think about that, how we've brought that through in terms of our investment approach, there's really 4 pillars. Taking positive action. So in this case, what are the goals we're going to set for ourselves around investing more in climate solutions and businesses enabling climate solutions? The second one is integration. So as Matt talked about, embedding ESG factors and impacts into our investment analysis and investment decisions. And importantly for us as a fund of funds, requiring our underlying investment managers that we work with to also do the same. So how do we allocate mandates, and what are the criteria that are important for us? The third area is about being an active steward. So aligning our stewardship role with climate commitments. Asset managers absolutely can exercise significant influence through constructive engagement with businesses, and that's what we should be doing. And then fourthly, it's about, whilst we recognise that value comes through positive inclusion and active stewardship, it's also about recognising the importance that exclusion plays, where industries are just a complete no-go moving forward. And so that's clearly played a part as well in terms of the development of our framework.
Mm. It's interesting. So for you, the investment function is part of a broader Westpac corporation. So how does this net zero work in the investment side fit into the overall corporate strategy?
It's completely aligned to the broader Westpac strategy. You know, our climate strategy is aligned to a 1.5 degree pathway, and the strategy really for us has, I always talk about it as having 3 key areas of focus. How do we what do we do ourselves as an organisation to reduce our own carbon footprint? So if you want to do it, then you need to also be showing that you're doing it actively yourselves. So we started measuring our carbon footprint in 2008, became carbon neutral through the use of offsets in 2013. But since 2008, it's obviously the big focus has been for us on reducing operational emissions. And we've made significant headway in that, reducing them roughly 65% over that time frame. And we continually reset goals for ourselves because we know this is an evolving pathway. The second area is really how do we support transition and adaptation? And we need to be thinking about both through our role as a bank. Banks in the New Zealand market are significant providers of capital, circa $400 billion of capital to the New Zealand economy. So we've got a really clear role to play here, and we need to be applying this as well. So when I talked about positive action before in relation to BTNZ, we've made a commitment as a bank to 10 billion of sustainable finance by 2025, and we're roughly a third of the way there in terms of our target. Integrating ESG factors into our credit decisioning. That's something we've been doing for circa 8 years. Active customer engagement, very big role that we play. We have a sustainable finance team in Westpac itself, and we spend a lot of time engaging directly with our customers on how do they frame up their own commitments, and therefore how can we provide finance to them to support that. And then lastly, exclusion. So coal mining is a case in point. We've been zero on that for the last 3 years. And we've been progressively reducing our broader fossil fuels exposure as well. And then lastly, the last point for me is, look, we're at significant size as an entity in the New Zealand market. And so again, we think we have a responsibility to engage in thought leadership and have a voice in market on these kind of issues. So examples of that, 2018, the EY Vivid Economics report on the path to 2050, Sustainable Finance Roadmap, obviously you've talked about. We were an original signatory to the Climate Leaders Coalition. We've signed up to the pledge, which is aligned, as I say, to the 1.5 degree pathway. And we were the first bank in New Zealand last year to issue a climate risk report aligned to the TCFD framework.
Cool. Thank you very much, Karen. That's great. And we'll pick up some of those points in discussion. I'll now bring in John Berry. So John is the Chief Executive and co-founder of Pathfinder Asset Management. They were awarded the Best Ethical KiwiSaver Fund and Best New Ethical Fund at the inaugural Mindful Money Awards in June this year by an independent set of judges, as I might say, not by Mindful Money. Before co-founding Pathfinder in 2019, John worked in law firms and investment banks in Auckland, London and Sydney. John's got a BCom LLB from Auckland University as a board member of Men's Health Trust. So, John, warm welcome to you.
Kia ora, Barry.
John, tell me why Pathfinder undertook a pledge, and maybe you can say a little bit about the pledge because it's somewhat more, how should I say, ambitious, and what will it mean for your investment approach?
Cool, thank you, Barry. So why did we undertake a pledge and a commitment? It wasn't driven by our board, although our board are very supportive and encouraging of us going further into ethical investing. It wasn't driven by our investors, but again, our investors are super supportive. It was really driven by our team internally, and especially by younger members of our team. And I think it's probably a lot to do with what you were talking about earlier, Barry, around purpose. You know, what is the purpose of fund managers and the purpose of investing and what the purpose of business? I think internally we recognise we have a climate crisis, and you know, so the natural step is to want to take action and to commit. And for us, when we were taking the pledge, the first discussion is, should we take the pledge? Once we've crossed that hurdle is, what is the pledge we're taking? And in 2050 is the standard. We're a B Corp certified business, and the B Corp climate pledge is 2030, which is ultra ambitious. But that's what we've signed up to. You know, what does it mean? You also asked, what does it mean for our investing? Similar story to, I think, Matt and Karen have just spoken before me, that we already could see the direction of travel when we, in relation to climate change and where the future was heading. And we already recognise climate change as the greatest threat for, you know, civilization and a great threat for investing. And we were already measuring our scope 3 emissions as a business. So that's our share of portfolio emissions. And we had a target to reduce by 65%. So that hadn't changed, but what did change by setting a target is, in a sense, it brought a lot more urgency and a lot more framework around the future. So rather than just thinking of here and now what our immediate targets are, it gave us a pathway into the future, and it shifted the focus from here and now into what are we going to achieve long term and how are we going to do that.
That's really interesting, that urgency and framework. I think those are really important points. We need to discuss those a bit more. John, can you give us insights as to what the pledge means in terms of how you're going to construct a portfolio? What will you do differently in your portfolio to get beyond the 65% reductions that are already in your targets? How are you going to drive this really to a real net zero?
Cool. Well, your go-to tool in the toolbox is reduce carbon. You know, it's a net carbon pledge, and net carbon means you can use offsets. Offsets are not your go-to tool. So you're looking to reduce. You don't just take out all the high emitters from your portfolio. If you did that, you'd end up probably just with a bunch of software and tech companies and quite an unusual looking portfolio. So you're looking to reduce, you're looking for best of breed. You know, for example, with airlines, for example, we don't invest in airlines, but if we did, you'd be looking for an airline that was the most efficient revenue to carbon relationship. So you're looking for best of breed within a country, within an industry. You've got to be forward looking and not just choose the lowest emitters, but also choose companies that are on the right trajectory as well. And so bringing them into your portfolio. Veolia is one company that in Europe had been buying coal boilers, so taking the carbon from other people into Veola's footprint, and then converting it to lower carbon emissions. So on the face of it, they had a reasonably high emissions profile, but they were transitioning away from the high carbon. So again, their leadership and their strategy was taking the business in the right direction. The first thing is reduce. Second thing is you're looking for solutions around climate change. I think of reduction, just taking out the fossil fuel companies, for example, is like exclusions, taking out tobacco and alcohol. You may not meaningfully change the world in a hurry. And if that's what we're setting out to do, is to have an impact on the real world and corporate behavior, you need to take a positive lens. And so positive lens is, tilt towards renewables or energy efficiency. Don't just look at public markets, look to private markets as well for opportunities where there's a lot of impactful companies and some great companies in New Zealand and opportunities in New Zealand. So second thing, look for climate solutions. Third thing around carbon zero in your portfolio is engagement. And I think Matt alluded to this, is don't just hand your voting rights as a shareholder to a proxy voter and sit back and let it all happen. Get actively involved. We voted as a business about 5,000 times last year. Within that 5,000, we identified about 165 votes that were really important environmental and social issues that we wanted to look at quite deeply. And on those, we voted close to 60% of the time against management wishes. So, be active with your voting, and engagement is also obviously talking to companies and engaging with companies to improve their or increase their commitment, increase their investment. A couple of things that I've mentioned, where I see this heading and what's going to be increasingly important over time. Bridget mentioned earlier on about the need to improve transparency, and that's around reporting. We've just released a sustainability report for our business and our portfolios, and that makes you think very, very deeply around where you're at now and where you're heading to. The important thing with reporting is don't just focus on numbers, don't just focus on compliance. It's actually focus on the thinking behind what you're doing, and where you're taking, where you're taking your portfolio, where you're taking your investing. That's the sort of information your investors want, and it's the sort of information you need to really achieve net zero in the long term. The other thing I'll mention as well is just challenges around data integrity. And this is something that will improve over time. With carbon data, it's hard to get perfect information. We spend a lot of time sanitizing the data that we do get. We have to work with the best we've got, but it will improve over time. So yes, there are challenges with moving to a low carbon, eventually zero carbon portfolio. It means changes to the way you invest, but we have to make this commitment. We have to make this pledge and make it happen.
Cool. Thank you, John. And I'd now like to invite the panel to come together. While you're doing so, for everyone else, please use the Q&A box to put in questions. We're going to have a couple of questions across the panel, and then a closing statement, and then we'll have time for a Q&A with questions coming in through the Q&A function. So please put in your favorite questions. Now, for the panel as a whole, I've got a related question, which all of you have mentioned, but is really a sort of a burning issue, that so many people hear net zero pledges by large financial institutions, and their first reaction is, yeah, right. And so there is a real authenticity challenge here. There's an authenticity around the organization, but there's also integrity around the pledges. So what are some ways that you think you can impart the reality of what you're doing? John alluded to, for example, being specific about the impacts of engagement and showing how engagement can make a difference. And I know, Matt, you've published your engagement with social media companies, which was great practice. What are some other ways that you can ensure that people are going to believe you when you say you're going to net zero? Because for some of them, they're not immediately there in terms of their thinking. Karen, do you want to kick off?
Yeah, look, I think that the point starts with understanding your current position. So this is where metrics reporting and third-party audit or review becomes really, really critical. And so for many of the investment managers, the starting point will be look, understand my current position before you start working out, well, what are my strategies to then change that. If I step back and think about just the Westpac example, our starting point was to understand our carbon footprint, understand what the sources of that were, and understand what the quick wins would be. First of all, to go, well, actually, how do I shift some of that? Exclusions was one of the earlier things for us. The second point for us about going carbon neutral and using offsets to do that, was it actually imposed a cost on us. And as soon as you start imposing a cost on yourself, you really want to take action in terms of doing that. That really drove us to dig deeper and understand more broadly, how do you then shift that emissions proposal. Now, from an investment perspective, it's no different towards in doing that. Understand the emissions profile of your current portfolio, look at where the next quick wins are to do that, and exclusions do play a part in some of that. But then where are the positive impact pieces that you can do? So what is the opportunity that sits out there, and start shifting your portfolio towards that, and make some really concrete commitments and very public, transparent commitments that support that, and make sure they're aligned to global best practice.
Yeah. And I think that point about offsets is a really important one. The last resort, not a first resort, and if people are cynical about net zero commitments, it's often because they think you're just going to buy them. Matt, do you want to express a view?
Oh, I think there's no gesture like a grand gesture. So I think it's right to be a bit cynical about these things. And the direct analogy is in the country situation. We've got a whole bunch of NDCs, which even if you add them up, probably don't quite get us there. But NDCs doesn't match the what's in the brochure doesn't match what the product is in terms of the policy. So same thing for investors. Get behind the grand gesture and start asking the harder questions about, well, how actually is this going to be delivered? And John gave some very good examples there. And that's what these investor commitments are doing. That investor climate action plan that Tom mentioned, part of the Paris Aligned Investment Initiative, is you've got to come up with that plan that shows exactly what you're doing, and then you have to report on that frequently. You've got to update your targets. So that accountability is created by that specificity. It's not enough to just do, kind of wave your arms around and go, we'll be there in 2050.
Nothing like transparency to actually be able to demonstrate what you're doing. And it does create the potential for accountability for the public and investors to be coming back to you and asking questions. Totally. John, anything to add?
Look, I think Matt and Karen have pretty much nailed it, but look, totally agree. It's easy to set an ambitious long-term target, a 2050 target for net zero. It would be easy to say, well, we've got 29 years to go. Let's do nothing for 28 years and then just buy a ton of offsets in 29 years' time. That's just not acceptable. And so I would say to business managers and leaders and shareholders, what you're looking for is actually embedding the thinking within your business. You need to embed the values and the carbon zero thinking within not just your leadership team, but right through your team. So that's internal. You need to take the team with you. Externally, you then need to tell the outside world that you're doing this. The more people you tell, the harder it is to hide anywhere. You're going to have to deliver to your customers and shareholders and community. And look, the last thing I'd say is the key thing is to get started and setting an ambitious goal is the place to start. Just remembering you can't do it overnight, and you've just got to plan for a lot of steps over, perhaps multi-decades to get you there, but you just need to get started.
Cool. So I'm going to call it quits there, and we'll have a chance to answer some more questions during the Q&A session. So Laura, I'll hand back to you.
Well, kia ora koutou, thanks very much, Barry, for that, and for that great session with Matt, Karen and John, and really, really great to hear those examples of organisations making net zero pledges, and then the challenges of how you actually go about turning that into a reality. So thank you very much. I want now to introduce a man who doesn't really need much introduction, but I will do it anyway, Adrian, who is going to deliver some closing remarks for us. So Adrian is the Governor of the Reserve Bank of New Zealand. Prior to that, he was CEO at the Guardians of the New Zealand Superannuation Fund. He was Chief Economist for Westpac Banking Corporation and Head of Financial Stability of the Reserve Bank. Adrian was also Chair of the International Forum of Sovereign Wealth Funds and Chair of the Pacific Pension and Investment Institute. And he's joining us now for some closing remarks. Kia ora, Adrian.
Kia ora, Laura, and tēnā koutou katoa to you all, and congratulations on what you are doing today, which is having the right conversations and getting started, as John said. Laura, I'm just across the road from you. I'm a free-range central banker here in Whanganui, Atara, and I just want to say thank you to all of you who aren't free-range up there north of, in the Waikato and north. Thank you for doing the hard mahi on behalf of all of Aotearoa in terms of keeping us COVID confident as best we can. Just before, just a couple of quick comments. I do want to thank Matt, Karen, Bridget, Barry, John, Tom, sincerely for all of the work that you are doing to promote this incredibly important role of the financial sector in being part of the solution, a significant part of the solution towards a more sustainable economic environment that all future generations can operate in. So full respect to you, particularly the way Toitū Tahua has really taken the challenge and corralling all of the financial institutions. And of the 193 participants I'm reading who are still there, get into it, boots and all, promise. The best time to plant a tree is 40 years ago or today, because really you have to get started now. We have two choices. One is do nothing and be victims, or two, get involved and think hard around how you can be moving not just your own business, but all of the interaction you have as investors towards a net zero future. At Te Pūtea Mātua, the Reserve Bank, we were very slow to the start line. I think governments and central banks have been slow, full stop, globally in coming to the party. Consumers, now investors, are leading the charge around moving us to a net zero carbon future. They're leading the charge through their own decision-making, their own choices, and they are dragging governments along, who will naturally be one of the slowest groups to it because they get voted in by the current generation and the current haves. They are not as much influenced by the future generations or the people who don't have a strong voice. So we need to be leading ourselves as humans, as business people, as investors, as consumers on this challenge. And that is exactly the korero that I've heard today, which is heartening. We may be slow here at Te Pūtea Mātua in terms of getting to the start line. We are at the start line. We are committing ourselves to all of the things you just talked about. Number one, getting our own house in order, our own footprint, our own behaviour. not just in terms of how we get to and from work or how we distribute the notes and coins to the country, but also our balance sheet. So we need to really make sure that we are not only having a well-positioned green balance sheet, but we're also enabling other balance sheets to move forward with us. So expect to hear a lot from us in coming times around how we will be a wonderful recipient of your fine quality assets, repo eligibility, as well as our own government bond portfolios in helping the financial markets price the risk. The biggest area would be the other part where the institutions we regulate, both the deposit taking, the banking sectors, as well as the insurance sectors, the questions that we can ask of them around how are they having regard to these significant risks in their own portfolios with their customers. And so this is happening. We can be a conduit for international knowledge, working with our network for greening the financial system, other central banks and regulators, bringing together stress tests, learning as a college together around how to ask the right questions, how to understand the answers that are coming from our regulated institutions, and seeing if we can incentivize them to be on course to a sustainable environment in the future. And last, we can provide leadership, and we're determined to provide that, mostly through what we can bring from our international connections, much like Matt has been doing through his connections through the NZ Super Fund, but bringing through a lot of international intel and sharing it at zero cost to you all. We can bring the horse to the water. We need you to drink from this, and we will be putting more and more of it on the table for people to share in. As recently as yesterday in our financial stability report we put out, I think we're making it very clear where our interests are, and they are firmly in this space around the key major risks that will impact New Zealand now and always into the future. And climate change is the big one in the room. It is that big climate risk. So congratulations for all that you're doing. Sign up, get involved. Tell everyone you're going to run this marathon, then you'll be forced to go out there and actually buy a pair of shoes and get started. Kia ora, thank you for the opportunity to chat. All the very best.
Well, kia ora, and thanks very much for that, Adrian, for setting out very clearly. I think we're all totally clear on the direction of travel for the entire sector. And of course, the critical importance of using our networks, sharing best practice, ensuring we're not reinventing the wheel, because of course, we're all in this together. So thank you very much for that. Now we have 10 minutes. I'm going to keep us very much to time, but we have 10 minutes, no, 9 minutes left over of our day for a few more questions from the audience of all our speakers, all our panelists today. And I've got a bunch of questions here in the Q&A chat bar. So I'm going to pick the ones that pique my curiosity and then throw them open to our panel. It might be nice if the bandwidth will bear it, if our panelists can turn their cameras on. Thank you. So one I like here is from Derek Parks. If our world is to have a secure future, is carbon going to need to be recognised not as an externality or bureaucratic operating expense, but as the reserve currency of the planet? How's that for conceptual thinking? Who wants to tackle that one?
You just let the guy off the hook who should be answering that one. Where's Adrian? There he is.
Adrian, there we are.
Yeah, you're going to have to take it off mute, Adrian.
I was pretending to be talking. I wasn't actually. And I also have to say I didn't quite hear the question.
I'm going to come back at you. Sorry. I'm sorry. I now have to scroll down again. Here we are. So if our world is going to have a secure future, is carbon going to need to be recognised not as an externality or bureaucratic operating expense, but as the reserve currency of the planet?
I really love that concept, and I think if people had those types of concepts in their minds, they are absolutely on the button. They are also thinking bold enough around what truly matters, and we should have a price that truly reflects the importance and the value of this asset. So, I totally agree. Reserve currency, I get the thought behind it, the moe, the spirit. It probably won't be a very good means of exchange, store of value, or unit of account, but it can certainly be an amazingly immense asset that is valued probably even more than some of those assets that are currently of no use whatsoever, but worth a hell of a lot. I won't mention Bitcoin at all.
Any of our other panelists want to take that on? I mean, really what we're talking about is we're talking about a completely conceptual shift in how we value things, aren't we? So I'll pause unless anyone volunteers. I'm going to come on to another one. Here's one. The announcement on carbon exposure of government investments has a 30-year phase-out period. We would be investing in fossil fuels right up to their end. Why not 5 years? And that question was from Robert McLaughlin.
I'll take that because I'm the Crown investor on the call. So the requirement from the Minister of Finance is that all the CFIs, the Crown Financial Institutions, sign up to a net zero portfolio emissions by 2050. But what all of those investors have done is committed to the pledge. That's what we were talking about earlier on. And what those pledges require is that you show how you are consistent with a 1.5 degree world, so a Paris aligned world. And that really is the sort of, if you like, that's the gating item there. Not that you've said the ultimate destination is 2050 zero, but that you are on that trajectory. And I think that when you look at what the CFIs have already done, they've already gone a reasonable way. Certainly the super fund has, and you'll see that more with the reporting and with the response from the CFIs to the minister. So the letter of expectations that we got requires a response by the end of this year as to how we're going to adopt this new expectation, this new framework.
Can I just add something to that? When you're thinking about 1.5 degree pathway, to Matt's point there, that's talking about 7.6% reduction year on year in greenhouse gas emissions. So nobody's sitting there and saying, I'm going to be status quo, to John's point earlier, until 1 year out. And if you did, to the question that was raised before, the price of that carbon through that period is going to be significant. So your cost of getting out is just going to get more and more expensive as time goes on.
Thank you. So I have another question now, which is, how do you balance divestment from fossil fuels with transition to renewables? So if a company has great transition potential and can be supported in that transition, would it be counterintuitive to divest from them? Who wants to?
Look, I'll happily take that one. If we think of a company like ExxonMobil, so we just don't want our money invested in traditional fossil fuel companies, and we don't feel as a boutique fund manager in New Zealand that we have the ability to change the company's direction. A hedge fund in the US, Engine Number One, has got 3 directors onto the board of ExxonMobil with new renewables experience to change the direction of the company, and that is awesome. But for us, we would rather than, if you're going to change the world, it's by engagement, or it's by positively putting your money into businesses that are going to make a difference, that are developing the new technology. I would rather leave the old world behind and look for the technologies, the new companies, and focus investment into those.
I'll just add to that, Laura. So yeah, similar concept to John. Where this manifests for us is where we look to reduce 2 things. One is the carbon emissions intensity, and one is our exposure to fossil fuel reserves. When we're thinking about the emissions intensity, we will keep companies in the portfolio that might otherwise go out if they can demonstrate significant outperformance in a relative sense in that transition opportunity space. We don't do that with the fossil fuel reserve owning companies, because in the same way as John, just don't see that those stripes, that those particular tigers are going to suddenly change their stripes anytime soon. So we do look for those transition opportunities, but that's more in the higher emissions companies.
Great, thank you very much. Now we have 2 minutes left, so I'm going to do one last question in a kind of quick fire way for people to volunteer. What is the single most important action each investor could make after making the net zero pledge? So what's the single most important action each investor could make to really get on the right track? Answers in one sentence.
Understand your current footprint.
Nice.
Embedded in every investment decision.
Yeah, I would say break it down into a series of steps into the future and take the easy steps first, which may be divestment.
Have a clear framework and embed it into your investment decisions.
Maybe get started now and recognize that the perfect is the enemy of the good.
Fantastic. Well, that feels like a really nice way to end in what has been an incredibly rich and wide-ranging conversation, huge amount of information. We're ending up with some little bite-sized actions to really galvanize progress on these things. You know, we've really had a very, very fruitful discussion. Thank you so much to all our panelists. Thank you, of course, to those who have convened us and spoken today and hosted. It's been a really, really, really engaging, interesting conversation. And of course, if money makes the world go round, money is what's going to keep our world sufficiently cool. So thank you very much. I've really enjoyed the session, and kia ora tātou katoa. Kia ora.
Kia ora.
Good.
Thanks.